Hi there guys, I hope everyone's doing really well. My name's Matt, I'm an economics graduate and Big Four qualified accountant. I trained in the audit department of Deloitte grad scheme between 2015 and 2018. Today I just wanted to bring you a pretty quick video aimed at helping anybody that may have an interview coming up for one of these roles, or really just anybody that is interested in better understanding how the audit process really works from start to finish and what it actually entails. I'm sure that anybody applying for an audit graduate scheme will already know that, broadly speaking, the work entails checking the accuracy of the financial results of the company in question. But hopefully after watching this video, if your interviewer is looking for a little bit more detail on the wider process, this will help you out. So what I'm going to do is talk through a sort of generic example of what the average audit engagement might look like. It's worth noting that some huge audits could involve a team of up to 20, 25 odd people, whereas some really small ones, that team might just be 2 or 3. But in my experience at Deloitte, the majority of engagements I was involved with, we were typically working with a team of about 7 or 8 people, typically comprised of a couple of first years, a couple of second years, an assistant manager, a manager and a partner. Under these circumstances, the manager and the partner would typically have relatively limited involvement on a day-to-day basis, and they'd be more there in order to provide support and answer any questions that the assistant manager had throughout the course of the audit. So what would happen is the assistant manager, the AM, would lead the on-site team of 5 or so people. They'd base themselves in a meeting room in the corner of the client's offices for the 2 or 3 week duration of the audit. In a nutshell, the work itself involves getting hold of the draft financial results of the company, which will typically be provided in the form of a trial balance, which will be extracted from Sage or whatever accounting software the business is using. We then categorise the TB into either P&L or balance sheet items, and from there subcategorise down to individual account lines, whether that be revenue, cost of sales, fixed assets, trade debtors or cash. At this point, each of the team members will be allocated a handful of accounts to be responsible for the testing of, and specifically testing the balance in question against the relevant predetermined audit assertions, of which there are 7, including completeness, accuracy, cut-off. I'd recommend that you familiarise yourself with these assertions, but what I'll do now is just run through a couple through the lens of revenue testing to better explain what the differences between them are. So assessing the accuracy of a balance might involve agreeing a specific line item within the revenue breakdown to the original supporting invoice to make sure that if £100 was included on the back of that transaction, the invoice in question actually states £100. And in isolation, this might seem like a relatively thorough check, but what we'd also need to do is assess the cut-off of the revenue breakdown we've been provided, whereby we want to make sure that all of the items included in that list relate to the correct financial period from a date perspective. It's important to avoid a situation whereby we end up with loads of accurate invoices, but actually half of them relate to the previous financial year. That'd obviously be an error in the results. So that's an example of how the assertions can sort of work together to check the overall balance from a number of different angles. So these assertions will dictate the specific nature of the individual audit tests carried out on different balances. But fundamentally what you're going to do is try and get hold of a breakdown or a listing of each individual account on as granular a basis as possible. So if that was revenue, we're looking for an invoice level breakdown. If it was the cash at bank balance, we're going to try and see a breakdown of every single bank account held by the business. And that logic holds in the vast majority of cases. You'll pretty much always want a really granular detailed breakdown of the balance that you're trying to test. And from there, you'll typically pick a sample of items from the list to test in further detail. And this sampling process has got a range of other nuances to it that I won't get into in too much detail now. If you're just joining as a first or second year, the sample selection is something that someone slightly more senior than you is probably going to be involved with. But what you're going to do is get your sample of items, whether that be 10 or 20 transactions from within the revenue breakdown, and you're going to agree these through to supporting documents. So in the case of revenue, that might be a sales invoice, but for testing different types of balances, you might want to agree it through to bank statements or payroll reports. It's worth noting that all of this work is carried out with what's known as a materiality threshold in mind, whereby we're only really going to concern ourselves with discrepancies or variances above a threshold which is deemed to be significant. If our business has revenue of 600 million and we manage to find one £7 invoice from last year erroneously included in this year's list, we're not going to be too worried about it as long as we can gain a degree of comfort that this is an isolated issue and not prevalent throughout the whole ledger. Determining these materiality levels in financial terms is again something that has its own degree of nuance and is typically done at the start of the audit by someone relatively senior, and then the whole audit sort of works to that same threshold. The threshold itself will be determined by loads of things like the size of the business, the sector in which it operates, the complexity of a number of the account balances, the extent to which there's been loads of errors reported in the past. The specifics of the materiality calculation probably aren't too relevant for you at this stage. You're certainly not going to be asked about the specifics of the calculation during your interview, but just being aware of the fact that this sort of threshold is in place throughout the audit is helpful. So then once all of our testing is done and all of our errors have been investigated, we report back to management on the findings that we've made and any adjustments that we recommend are posted. And typically what they'll do is say, oh yes, you're right, we'll amend that number now. Occasionally you do get instances whereby there's disagreements, the basis of calculation is challenged, all that sort of stuff, and that's where the manager and the partner will step in, sort of defend the opinion that the audit team has arrived at. And that's basically how it all works, and what you hopefully end up with is a materially accurate set of financial results which give a true and fair reflection of the underlying business. I hope that gives you a sort of useful overview, a useful summary. I know it's a pretty quick, but hopefully if the day-to-day operation of an audit does get brought up in your interview, you're slightly more prepared now. I think audit can be one of those things where people are keen to get the brand of one of the big four companies on their CV, so they can go into it without actually knowing what the nuts and bolts really entail. So hopefully this has given you a little bit of an overview. Any other questions or you want anything clarifying, feel free to drop me a note down below and I'll certainly get back to you. That's not a problem. Other than that, that is it from me though. All the best till next time, guys. Bye bye and stay safe.